Good evening, everybody. It's Scott Gillum with the live stock and options trading room here on ShadowTrader.net. Today, let's take a look at Boeing. Boeing Aircraft had a lot of problems with bad production of fuselages. They've had some FAA intervention in their management. They've got a new CEO stepping in to its seat there in January of next year, and we've had a union strike that's going on. That's all been bad for Boeing. You can see in the last 6-7 months, the stock has done nothing but fall, kind of consolidate, then another piece of news hits, falls again, tries to recover, and falls once more. Right now, with the price of the equity, that's made a big reversal from the 145 level. We now have the potential of this pushing through a consolidation area that goes really at about the 160 level or above to the next area of consolidation, 172, 175, with a potential to move back if everything is resolved and back working in the Boeing manufacturing plant once again, possibly back to the 200 level. But that's not where we are today. Today we've got earnings coming up on Boeing on the 23rd of October. That's next week. With the strike still pending, earnings not being as robust as they have been in the past, and you can see the last earnings was a big drop. The earnings before was kind of a flop. 3 earnings ago, we had somewhat of a minor pop to the upside. So I don't see any risk to the upside at this point. But here's how I want to play it. I want to be selling credit above and at this consolidation area back from mid-August, capping that off with about a $5 call on the upside. Then I'm going to look to use those proceeds to buy something further out in time at this breakout point of around 190, 195. So here's the trade setup. Going to ride over earnings and use that October 25 time frame. I know this is a little risky, but it works out. Sell the 170 call, buy the 175 call, to cap that risk at $5. And if I use those proceeds that are about, I sell for $1, I buy it for about 60 cents. So I've got about 40 to 45 cents of credit in pocket on this trade. This trade alone is going to have about a 70% probability of keeping all that credit. Here's why and what I'm doing with that credit. I'm taking that credit, moving it out to a November 15 expiration, and I'm buying a 195 call with those proceeds. In essence, I'm using the bear call credit to buy a long call out here about 30 days from now, after the election, after what is expected to be the resolution on the strike. The trade itself, how does this work out? Well, I can't give it to you in percentages as to what we're going to make because we've got 2 expirations. First expiration goes to the 25th of October. The next one goes out to November. But in essence, if we don't go above that 170 strike price into earnings and everything stays in force, I now have a free 195 long call out in November to play with. So if I use that 195 long call as an individual item, stock moves, let's say, to 170. Well, my zero cost call will in essence go We're going 156 to 170. That's 1, 2, 3 strikes above. So I would go 1, 2, 3 strikes for value. This zero cost would now give me a credit of around $155. So there's your trade. Sell the 170 call October 25, buy the 175 call October 25, use those proceeds and purchase a 195 call November 15. Thanks, everybody. Have a great rest of your day. Bye-bye.
Hi there, this is Scott Gellam from the Stock and Options Room of Live Trading Suite. If you enjoyed this video, please hit the like and subscribe buttons down below. And if you'd like to trade live with me in real time, click again that link in the description below. Good trading to you all, and I'll see you in the room.